Welcome to the Hamilton Project event on small businesses and supporting firms and the risk of failure. I'm Wendy Edelberg, Director of the Hamilton Project, and I'm very excited for the event that we have for you today. It's part of a series of events where we have explored how the COVID recession will affect the economy both in the near term and in the longer term, as well as policies that would be helpful to mitigate some of those negative economic effects. You can go to our website to see materials about these past events. For example, we have an essay about how the recession is affecting the labor market, other aspects of the economy, how it's having a disparate impact on people of color. You can also see the proposal that we published today on small businesses, policies to help small businesses, by Steve Hamilton from George Washington University. Shortly, we will be welcoming Senator Cardin. Senator Cardin is the ranking member on the Senate Committee on Small Business and Entrepreneurship. He'll be offering some framing remarks, and then I'll be able to ask him some questions, both from us and from you. And then we'll have a panel where Steve Hamilton will present his proposal, and we'll hear from other experts from inside the trenches and offering a critical view of how different kinds of proposals to help small businesses would help firms' incentives. By the end of the event, you will learn about how small businesses are essential for the economic recovery, and you'll learn about the worrying landscape that they currently face, and about pros and cons for different policies to help those firms. Thank you to everyone who has submitted questions so far. We'll continue to take your questions throughout the webcast, so you can email us at info@hamiltonproject.org or send us a tweet to our account @HamiltonProj. We will also be live tweeting the event with the hashtag COVIDeconomy. I will be going through just a few slides to give some highlights about how the economy is doing. These are taken from a document that we published today on the Hamilton Project's website that offer 10 facts that summarize how the business sector is doing, how the labor market is doing, and how the household sector is doing. So now I'm going to attempt to share my screen to show you my slides. All right, so let's start by comparing this recession to previous recessions. There are 11.5 million fewer people who are employed right now relative to what we saw in February. This purple line is our current reality. Look at the severity and speed of the shock to the labor market in comparison to past recessions. At first, employment contracted by 14%. That's more than double the worst of the contraction following the Great Recession. That's the blue line. The purple line is climbing back. Partial recovery is what we've seen as some economic activity has resumed. But here's what to expect. This will morph from a recession caused by the onset of a pandemic to a slowdown characterized by millions of permanently lost jobs. And that means the speed of the recovery will start to look more like the slow, painful path coming out of recent recessions. So what does this mean for retailers? What does it mean for consumer spending? Well, the news has been surprising in some ways. The effects on certain parts of consumer spending are different from previous recessions. So once again, the purple line represents our current situation and shows how things have fared relative to past recoveries. As you can see, overall retail sales have rebounded, but that's because spending has been relatively strong on goods. Spending at restaurants and spending on services are still down. So what does that show? It means that the pain felt by businesses is not evenly felt. Not surprisingly, the waters are roughest for small businesses. Let's take a look at the numbers on how small businesses have been hit and are still being hit. This is an illustration of different sectors and how their revenues are faring. The pale green line represents revenue in the leisure and hospitality sector. Compared to the average daily revenue in January, revenue as of August 9th was down nearly 50% for them. The purple line is the education and health services sector. It was hit by nearly 20%. And the top line, the blue line, That's the retail and transportation sector. It's showing a relatively small drop of 15%. So summing up, the black line shows the average of all small business revenue. It has fallen by nearly 20%. Lastly, you'll notice something disconcerting. Some of the sectors have begun to see revenue declines again in recent weeks. And then what some would say is inevitable. The decline in business revenue has caused many firms to become insolvent. In fact, Steve Hamilton, our author of the proposal today, estimates that nearly 420,000 small businesses failed between March and July. That is the number of failures typically seen in an entire year. Nevertheless, only Chapter 11 bankruptcies, in which a plan for reorganization is negotiated, have been higher than last year. They're represented by the purple bars here. Although larger firms can benefit from entering Chapter 11 bankruptcy in order to reorganize their operations, many smaller businesses seem to have opted for outright closures instead of taking the time and the money to go through Chapter 7, which is represented here by the blue bars. So Chapter 7 bankruptcies, in which the assets of the firm are simply sold off to pay the bills, those decreased sharply from the same time last year and remained below their 2019 levels through August. Finally, Chapter 13 bankruptcies, for people to enter a repayment plan with their creditors, have been way down. They're represented by the green bars. Surely some of the decline in Chapter 7 and Chapter 13 bankruptcies stems from court closures and other logistical challenges created by the pandemic. What we don't know is what will happen to bankruptcies in coming months, and we and many others will be watching this closely. Of course, for those businesses that haven't failed or haven't declared bankruptcy, the picture's not good. Many firms reacted to the COVID-19 pandemic by reducing their operations. In fact, aggregate hours are down almost a third from pre-pandemic levels. That decline is not due to reduced hours worked per week. It is due to layoffs and shutdowns. In this chart, layoffs are represented by the blue bars and shutdowns by the green. As a sign of the continued distress of firms, roughly 20% of firms are fully, but hopefully only just temporarily closed. And survey evidence shows that as of early September, nearly 90% of small businesses in operation that laid off employees hadn't hired back any of these workers yet. Reopening businesses and businesses bringing back laid off workers will be critical to the recovery. Indeed, post-April employment gains came mostly from reopening businesses. So Congress did a lot to support businesses in March, but that support was temporary, and it was not sufficient to keep businesses viable through these months. And Congress needs to do more to support small businesses and the recovery going forward. And now I am delighted and honored to offer the floor over to Senator Garden, who will offer some framing remarks. Senator, the floor is yours.
Wendy, thank you very much. I certainly agree with your last comments. The CARES Act was very, very important. It passed by an overwhelming bipartisan vote by the United States Congress. It provided meaningful help to all segments of our economy and to deal with the pandemic itself. And as you look at that first couple charts you showed, you see these sharp reversals of the declines. The CARES Act played a major role in making that a reality. But you're also correct, it was a measure passed in March when we thought the pandemic would be back to some degree of normalcy, certainly by now. And we're not anywhere near where we thought we would be when we passed the bill in March, and Congress needs to do more. So let me just back up and thank the Hamilton Project and Brookings for what you're doing. The panel that follows is really a group of experts, and the proposals are ones that I really look forward to reviewing. I'll just give you a little bit about my own personal background. I was elected to the Senate starting in 2007. When the majority leader at that time, the Democrats were in the majority, asked what committees I wanted to serve on, I think he was surprised to find out that one of the committees I put down was the Small Business Committee. I chose to serve on that committee because I recognized in Maryland and throughout our nation, small businesses are the growth engine. That's where you get innovation. And in my family, I've had My grandparents started a small business and became a big business, but that's how it is. I mean, you figure out a better way to do things, and you get job growth, and you help our economy, and you help all. But one thing about small businesses that we've learned from every recession is they're not as resilient as larger companies. They don't have the deep pockets, and they are much more vulnerable to being out of business during a recession. We also have learned in recent years, when we've had a tight labor market, that retention and recruitment of employees is very difficult for small businesses in the labor market. And that was one of the thoughts behind the PPP program, which I'm going to get to in 1 second. But the work of the Small Business Committee that I serve on has always been, since I've been in the United States Senate, a bipartisan committee. So when we started to see the pandemic reach our shores, Senator Rubio, Republican from Florida, and myself, a Democrat from Maryland, the chairman and ranking member, we got together and started working on proposals that would help small businesses get through this pandemic. And during those early discussions, we talked about new tools to the Small Business Administration to be used during this pandemic. It included the PPP program, and included the EIDL program, and included some other issues. But my point is that we had already worked on these proposals by the time the leadership got around to putting together a bill. So we were well ahead of the curve. And as a result, we were able to get robust bills and lots of funds available to help small businesses. The very first effort passed was before the CARES Act, when we passed legislation making businesses eligible for the Economic Injury and Disaster Loan, the EIDL loan, as a result of the pandemic. Normally, the EIDL disaster loans are for natural disasters, hurricanes, tornadoes, fires. We made it available by Congress for a pandemic, so that those funds were available early. And the EIDL program, and I'm going to talk about that a little bit later, is a very important program based upon need. So it does help, and it helps you with working capital. But we created a new program, the Paycheck Protection Program, PPP. Our effort was to get money out quickly, to cover 8 weeks of payroll, to cover some other expenses, so that small businesses could keep their workforce in place to get through this pandemic, which we thought would be about 8 weeks, and everything would be rosy, everybody would be happy, the workforce would be there, you didn't have to use unemployment insurance. It was a win-win-win situation. Well, we were successful in getting money out quickly, and we're very pleased about that. The program, for the very first time, provided help through the Small Business Program 7A loan for nonprofits, because we recognized nonprofits were in desperate need as well. And we provided help up to $10 million. And as you know, we came back and modified the program to provide additional flexibility so the monies could be spent over a 24-week period rather than an 8-week period. The allocation between payroll and other expenses was determined by Treasury, but we changed that when we came back and updated the program so that we gave greater flexibility for other expenses to be paid under the PPP program. But we also had separate rules for the hospitality industry, since we knew the hospitality industry at the time. We realized they were the ones that were the large industry of small businesses that were being hurt probably the most. But we did more, and we put, by the way, originally $349 billion into this new program. That's a big hunk of change. It wasn't enough, so we added another $310 billion to the program. And we did something on allocations, and I'm going to get to that in one moment. The program worked. 5.2 million small businesses took advantage of the PPP program. 5,500 lenders, $525 billion was loaned out. Average size of the loan was about $100,000. But we also changed the Economic Injury and Disaster Loan Program, the EIDL program, by providing for the first time a grant. And let me make this clear. The PPP program are 7A loans by banks, commercial institutions. There are loans that are completely forgivable if you spend the money the way you're supposed to, but it's done through commercial lending. The EIDL program are direct loans by the SBA. So we control that. and we can get into communities that are difficult to serve through traditional banking outlets. So we modified the EIDL program to provide a $10,000 grant, cash, not a loan, upfront money, because small businesses are afraid of loans. They don't know if they can pay them back. So we developed a grant program up to $10,000 with a requirement that the money get out within 3 days, because we wanted that money out quickly. And that program worked very, very well, although the average grant was between $4,000 and $5,000, not what Congress had intended. Then we had a loan forgiveness program for existing loans under the SBA. So you get 6 months of loan forgiveness, and that helped those who had existing loans that had difficulty to pay them back. And then I, along with Senator Wyden, had introduced a legislation under the Senate Finance Committee that would provide for employee retention tax credits, so that we offered a tax incentive to keep people employed for small businesses or to bring employees back for larger companies. More flexibility for smaller companies, giving a tax credit of up to 50% of the wages you pay, up to $10,000. That was the menu that we passed last March, and it worked very well. What were the lessons learned? Well, we did learn under the PPP program that unless we do special things, the underserved, underbanked community is not going to do as well. And there are many reasons for that. The natural tendency of banks to want to do business with those who they already know, and that banks tend to want to make larger loans than smaller loans. And the larger loans are not in the underserved communities. The larger of the small businesses, they're the more established of the small businesses. We also knew we had to do something about that. So when we returned to replenish the funds, we allocated a certain amount of the new funds to mission lenders, to those that are serving the underserved community. We also were extremely disappointed by the lack of transparency by the Small Business Administration. That's not just a Democratic senator telling you that. The Inspector General said the same thing. GAO said the same thing. Marco Rubio said the same thing. So we were very disappointed we didn't get the material out quick enough so that we could analyze and know where we wanted to go next. And as I said before, we have now conceded that we need a second round, that the one round of PPP was not enough. That's not, again, just a Democratic senator saying that. That's also Marco Rubio, and that's also Steve Mnuchin, the Secretary of the Treasury. We all agree that we need a second round. So what do we want to do in a second round? Well, I can tell you, as we did in previous to the putting together the CARES Act, Senator Rubio and I have been working very closely together. We're ready. As soon as our leadership gives us a green light that we're going to have a bill, we'll agree on a bill. We haven't agreed on all the things yet, and make that clear, but I think we can put this together pretty quickly. We have money left over from the first round, about $133 billion. So we have some money to work with. But we believe that a second round, particularly a PPP, needs to be limited to those businesses that really need it. So both Senator Rubio and I believe there needs to be a revenue test, whether it's 30% or 50%. As I look at your charts, Wendy, I can tell you, you see that the 30% seems to be a number that can work to get to those businesses that really need the help on the second round. Senator Rubio believes we should cut it off at businesses 300 employees and smaller. I can tell you that I would like to see us provide additional help for the smaller small businesses, and legislation I authored provides a set aside for those small businesses 10 and under, because they're the ones who really need help. So we want to go to the smaller of the small businesses, and we want to go to those who really need it under the PPP program. But we also want, as part of this, to deal with the capacity building within the minority communities, within the underbanked communities. So there's a bill that I introduced with Senator Cantwell, Schumer, Booker, Cortez Masto, and Harris, the Minority Business Resiliency Act, that would codify the Minority Business Development Agency, which is by executive order today. We want to make it statutory, and to provide partnerships with HBCUs to help minority communities. We also would like to see funds go into CDFIs to build up their capacity to loan in underserved communities, so that we don't have the same problem on the second round we had in the first round. In the first round, the money did not get out quickly to the minority communities, and the loans weren't as large. We want to make sure that we correct that when we go into the second round. But there's another part of this we need to deal with, and that is the EIDL program. The EIDL program was intended to give loans up to $2 million for 30 years, low interest, with no payments for the first 2 years. The administration, SBA, administered by limiting the amount of the EIDL loan to $150,000. We don't think that's right. We think that should have been higher loans. They don't have the capacity now. We need to replenish that program. The EIDL program, by definition, goes to those businesses that need it. You have to show need as part of getting this loan. And it's long-term loans gets you working capital, where the PPP program is more for just current expenses. So we think the EIDL program works very well with the PPP program, and we need to make sure that in the next round, we replenish the EIDL funds. We also need to replenish the funds for the EIDL grants. And on the grant side, we think the grant should have been much higher than what the SBA did. They did about $1,000 per employee. We think it should have been, for some companies that are small, they should have been able to get the full $10,000 grant. We also want to improve the tax credit, the Employees Retention Tax Credit. And in the HEROES Act, which is passed by the House, they make it 80% up to $15,000 on the credit side, and also make it clear, which is not true under the CARES Act, that a small business that takes advantage of the PPP program or EIDL program or both can still take advantage of the employees' retention credit, which is not the case today. So that's where we are as far as trying to get this moving. It's not in our hands. If it was in Senator Rubio and my hands, we would have had this passed well before now. We know that there's negotiations taking place which deal with state and local government, deals with unemployment insurance, deals with frontline workers, deals with our schools, deal with the healthcare issues. And I must tell you, that's important to small business. Make no mistake about it. If state and local governments don't have capacity, it's going to hurt small businesses. A lot of our programs to support small businesses is done through the support of local governments. So we need to have those programs in place as well. My hope is that we can get something moving. I would like to tell you next week. Let's hope that's the case. We cannot wait till after the elections. Too many small businesses will have folded by then, and your chart will reflect that. I can tell you, we're ready to act. We're open to suggestions, and we will continue, Senator Rubio and I, continue to work on behalf of small businesses in a bipartisan manner. Thank you, Wendy.
So that was terrific. Thank you, Senator. That was wide-ranging and incredibly informative. You talked about negotiations and areas of disagreement between you and Senator Rubio. But then you also talked about, it sounded like with a level of optimism about maybe something happening for small businesses within the next few weeks. Can you talk a little bit about where you see the sticking points for something happening on small businesses in the near term?
Thank you, Wendy. Yeah, Senator Rubio and I are not in agreement on all points. I can tell you with a great deal of confidence that once we understand the resources that are available and we have a bill that we can work with, that is, the overall bill has been put out there that we're going to pass a bill, we'll work out our disagreements within a matter of minutes. We don't even need a full day. We'll work out our differences because we've had open discussions and we're not far apart. The most important point is additional resources going into EIDL. We need those funds. And we have to figure out how much resources are available for the PPP program in EIDL and have a fair adjustment. This is not a partisan issue. Senator Cornyn and Rosen have introduced legislation to provide, I think it's about $150 billion more for the EIDL program. So there's a bipartisan effort to do this. And we've heard from the Republican members of our committee, this is important. So they're the issues we really need to iron out, but we'll iron those out. I'm not as optimistic that we'll get our leadership together on next COVID round. State and local government, they're very far apart about. There's a liability issue that they're very far apart on. Unemployment insurance, they're still very far apart on. So there's many of the parts are not in the same position as small business. There really is not a willingness, there is a real desire by the Democrats and the Republicans to do a second round to help small business.
So you mentioned the employee retention tax credit, which is actually an essential part of the proposal that Steve Hamilton wrote for the Hamilton project that we released today. That of course would be implemented by the Internal Revenue Service. Do you have views on whether or not the IRS has the resources to implement this and other kinds of help that we are looking to them for to support small businesses?
Well, I'm going to be careful the way I say this. I don't think Congress has been as kind to the IRS as we should have been. We've given them a lot more work to be done. The 2017 tax bill was not an easy bill to administer. We have passed Taxpayer Bill of Rights, as we should, to protect taxpayers, which requires additional work on behalf of the IRS. Congress passes these bills and assumes that the IRS can get all the work done, and we don't give them the resources or the time necessarily to get it done right. Senator Portman and I have been bipartisan champions for making sure the IRS gets the tools they need to carry out our laws. Sometimes it's not easy to go back to our constituents and say we're giving more money to the people who are collecting our taxes. But we have to make sure that they have the resources to carry out these laws. Yes, I think they have the competency and the resources to carry out the retention credit and the changes that we're looking at, but we have to give them also additional resources to be able to carry out these additional administrative responsibilities.
So we only have a few more minutes, and I have a great many questions from our audience. We're very excited to have the opportunity to hear from you and ask you some questions. So I'm going to try to sneak in 2 more questions in our next few minutes. So one is, do closed businesses need a different kind of support than businesses that are open but facing substantially reduced revenues?
Yeah, absolutely. That's a great question. And that's exactly what we're trying to do is have, again, the idea of CARES was we were right in the beginning of a pandemic. We knew businesses had virtually no revenues. We wanted to keep them open. We wanted to get the money out quickly. We knew that some businesses would get the money, probably didn't need it, but we didn't want to have to get so much paperwork that by the time you filled out the paperwork, your business is closed. So we erred on the side of getting money out quickly. And I think the program was very successful. I think we did it right. On the second round, we're not going to do it that way. We're going to target it to the businesses that really need it. So under the PPP program, there's going to be a revenue test. You may not have to be closed, but you're going to have a substantial loss of revenue in order to qualify for that second round. But the EIDL program is based upon need. So we can craft the EIDL program loans. These are 30-year low-interest loans to prioritize those businesses that are otherwise shuttered because they don't have the resources to keep the lights on, literally. So yes, we can do that, and we intend to do that. That's why I keep on mentioning EIDL in addition to a second round of PPP. We need both of those programs funded and functioning. And the last part, I would say, we want to get into the underserved minority communities because we know they are the most vulnerable. And yes, they have a lot of shuttered businesses there. So we want to beef up the resource partners, the minority business development agencies, the women's business centers, these resource partners who can help us in the community get information out so that particularly small business, really small businesses that don't even know about all the opportunities, know that they can reopen and how they can get help to reopen.
That was super. And in fact, covered my next question. We can give our hearty thanks to you. Thank you very much, Senator Cardin, for those really insightful remarks. And I am now going to pass the baton to the Hamilton Project's very own Roger Altman, who will be moderating the next panel.
Thank you, Wendy. And let me thank Senator Cardin again for joining us today and for the trenchant remarks he made. We very much appreciate it, Senator. I'm just going to make a few comments by way of introducing our panel and the discussion which follows. And I'd like to make 4 points. Steve Hamilton, and thank you very much in advance, Steve, has presented a very good paper, together with three quite provocative recommendations. My first point is, I think the dimensions of this crisis may be, and that by that I mean the small business crisis and the rate of failures among small business may be greater than Steve's paper implies, and even than the discussion we just had implies. In New York City alone, the New York City Partnership, which is a very well-respected group from the business sector, which advises the state and the city on New York City, has projected that as many as 120,000 businesses in the 5 boroughs of New York City alone may close. And Steve's talking about 420,000 in the country as a whole. If the New York City figure is correct, Steve's figure is probably understates it. Secondly, I think it's understandable the comments that Senator Cardin made about the PPP program. He had a lot to do with it. Steve's paper proposes that we not extend it further, so we'd like to get into that discussion. And I would just say that the PPP program did save a lot of jobs. There are 2.3 million jobs initially estimated as having been saved, but at the same time, it was quite flawed. And I think we'll talk about those flaws, during the panel discussion. Thirdly, it's fine to talk a lot about how to refinance small business and take closed businesses and reopen them. But remember, these businesses have to have customers. And if anybody listening here owns a small business, whatever financing may be available to you or not, doesn't solve the problem of having insufficient customers and insufficient revenue. And so if you think that your revenue will be so below historical levels, or way below historical levels for some time, it's difficult for financing to solve that. So let's keep that in mind. And finally, there have been a lot of analogies used as to the impact of the pandemic on small business and on the economy as a whole. I'm sure everybody's heard analogies about natural disasters and how, and Steve's paper talks about this, how following a natural disaster, businesses are in the affected areas are severely affected, but then they bounce back very quickly. But there's not much evidence, in my view, that the pandemic is analogous to a natural disaster. We are 6 or 7 months into it now, and we can all see that the economy remains, as Wendy said, way below pre-COVID levels. 11.5 million Americans who had jobs in February don't have them now, and so forth. So I myself find that analogy, the natural disaster analogy, and programs that are natural disaster oriented programs, to be a rather tortured one. So we'll get into that. So let's go to the panel. As I said, Steve Hamilton has written this very good paper, which we released today. And Steve is an assistant professor of economics at George Washington. We're very pleased to have Glenn Hubbard, who's so well equipped to talk about this, both between his government experience and his Columbia Business School history. Glenn was dean of Columbia Business School for some time, and very successfully so. Tom Sullivan, who runs small business policy at the U.S. Chamber of Commerce, and Lou Zaricia, who is CEO of the Opportunity Fund. So let me begin by turning to Steve and asking Steve, if you would please, by the way, Steve is joining us from Australia, where it's about 4:30 in the morning, so thank you especially for that. But let me just ask Steve to summarize his paper, and in particular, the proposals you've made, Steve.
G'day, Roger. Thanks so much for your remarks. I've been thinking about small business very, very intensively for 6 months since starting this project and since COVID-19 began. And as I was writing the proposal, the thing that was striking was how quickly things changed, right? So things were changing as I was writing. And in fact, my policy prescriptions that I was thinking of devising changed as I was writing, right? So I think when we're devising support for small businesses, we need to be very mindful that as conditions on the ground change, the policies that are appropriate for those conditions must also change. So I think I was a strong supporter of the PPP back in March. I think it was, it was imperfect, but it was in principle, I think, the right kind of package to give very generous support to businesses for a very short, sharp lockdown to give us time to get the pandemic under control. And that's what happened in a lot of countries. In a lot of countries, we suppressed the virus. And I can tell you in Australia for the past few months, in most places, we've been living without any restrictions. The problem is in the US, we didn't do that. The small businesses opened after a couple of months, and they entered an environment that was very hostile and very uncertain. And we've seen really, really dramatic effects on those businesses as a result. So, as Wendy showed in her diagram earlier, small business revenues have plateaued significantly below their pre-crisis level. And I don't think we can expect that to end anytime soon. So I think if we're thinking that this period of subdued revenue is going to be a longer period than we anticipated, then I think we have to pivot in our support away from an extremely generous short-term support mechanism to a slightly less generous, better targeted, but much longer term support mechanism. And so in the paper, I propose a scheme of that nature. So what is the proposal? The proposal is a significant increase in something called the Employee Retention Credit, which provides 80% salary support up to $15,000 per quarter. So that would give a massive boost to small businesses, right? To almost cover their payroll, not completely, but 80% up to a cap. So that favors medium to low income earners, and I think would be a huge support. The second part of the proposal is recognizing something very, very important that we learned from the PPP and that a lot of small businesses have complained about, and that's that support for payroll is not enough. So if a business is closed, they're not paying their workers, but they've still got to pay the rent, right? Even if a business is open, businesses in this environment face significant increase in their cost base, right? Because they have to invest in mitigation measures for COVID-19 and all sorts of other things. And a lot of businesses can do a lot to reduce their variable costs, but ultimately there'll be this fixed cost base that they can't avoid. So we can't just help with payroll. We need to help in a more flexible way. So I've proposed, in addition to the Employee Retention Credit, something called the Small Business Survival Credit, which would give small businesses additional $5,000 per worker for the first 10 workers to cover fixed costs like rent, interest, utilities, and COVID mitigation costs. And so what that in effect would do is provide a massive incentive to hire employees for businesses with fewer than 10 employees. So if you're a business and you have fewer than 10 employees, you're going to get a very large tax credit for each employee that you have on the books. And that gives you a really strong incentive to keep those employees on the books, but also to hire new ones. Now, if you're idled, if you're closed, you'll still get some support, right, to cover those fixed costs. Overall, this package, radically favors smaller businesses, right? Businesses with fewer than 10 workers, the 80% of American businesses with fewer than 10 workers, and is much better targeted to, say, businesses with at least a 30% revenue loss. So, you put all of that package together, and what we can do is by targeting the support and making it a little less generous, but designing it in a way that better matches firms' needs, you end up being able to fund a package for roughly 9 months that costs a similar amount to what the PPP cost over 2 months, right? So to me, pivoting to that new design is going to be a kind of critical thing in the next few months.
Steve, talk for a moment, if you would, about the third part of your proposals, which or your proposal, which concerns the IRS.
Yeah. So this is, I mean, I'm a tax economist, so I think about the IRS more than most people, not just once a year. So I would say a significant point here is that in all across the world, governments gave support to small business and support to wages. Everywhere in the world, they provided it through their tax authority. In America, we provided it through the banks. And there is a huge volume of research showing that funneling the money through the banks was involved with sort of frictions and limits to who got the money and when, right? It favored existing banking relationships. It favored, it disfavored disadvantaged areas and so on. So, providing through the banks made the money go out fast, but it made the scheme kind of really quite imperfect in the distribution. So ideally, a scheme would have given money to the IRS, right, to provide that funding. Now it didn't, and it's hard to sort of get around the fact that that's really because to roll out a program like the PPP in the time it took to roll out the PPP, the IRS just would not have been capable of doing that at the scale necessary, $500 billion of support. So, moving forward, I really think a priority for the government needs to be getting away from this silly, starve the beast mentality of a sort of anti-IRS posture, and to be realistic and say to have a modern, prosperous country. We need a tax authority that can support us. We need to give it the funds we need so that in future crises, the IRS can deliver this funding to all in a fast way.
Steve, let me also ask you this, and then I'm going to turn to the other panelists. Senator Cardin said that while he and Senator Rubio concerning the small business provisions of a further COVID relief bill are pretty close together substantively, the leadership is not yet is not yet closing the gap.
Right.
Many people think that they won't successfully do that, and there really will not be a further economic relief bill either before the lame duck session of the Congress, assuming there is a lame duck session, or maybe even more likely until a new administration takes office, either a second term for the current administration or obviously a Biden administration. So if there is not another relief bill until, say, February, would that affect your proposals at all? And how would you feel about Senator Cardin's point, where he obviously favors in effect, a third iteration of the PPP program?
Right. So I think it's very clear that if we have to wait until January, an extremely large number of small businesses will fail. There is no getting around that, in the hundreds of thousands. Already, as Wendy pointed out before, we see that starting to turn, right? We see revenue starting to come back down. We see permanent closures start to accelerate. So businesses have been coasting on their PPP funds. They've run out. We can't last till January. So that would be catastrophic, frankly. If we had to last, I would still support, even in January, providing targeted support in the manner in which I propose to do. So I think for the first 6 months of next year, businesses are still going to need support, the ones that are around. And so I would still favor doing that. Now, look, it's hard for me to say, it's hard for me to sort of comment on the Congress, but the problem we see is that we agree on some parts of the bill, but not others, right? So we have these disagreements in some areas and agreement in others, and this unwillingness to decouple these items from one another, I think is really staggering. And as I mentioned in the paper, millions of small business owners are looking on, thinking, well, your quibbles have nothing to do with me. You agree on helping me. Let's put that aside and let's deliver what we can. So I would really implore the Congress to sort of put aside the items of disagreement and at least pass the things that they can agree on.
Okay, I'm going to turn the question to Glenn Hubbard. And Glenn really, as I said in mentioning the panel initially, is so well positioned to comment on this. And so, Glenn, I have a two-part question. First part is, what's your own assessment of the effectiveness of the federal response so far as it relates to small business? And secondly, can you give us your reactions to Steve's proposals and any ideas you yourself have as to how you would sculpt this if you were in charge?
Sure. Thanks, Roger. And thanks, Steve, for really an excellent paper. It's a hard question because normally if you ask economists, would you give direct support to small business, you'd get some skepticism. Normally we would say, well, fight the virus, get macro policy right. And those clearly are the two first steps to do. And Steve acknowledges those well in his paper. But I do think there's a strong case for direct aid. And I do think the Congress got a lot right in the CARES Act, even though it went very fast, and I might have done it a bit differently. And I'll come to that. I think by and large, we shouldn't be too critical given the speed. In fact, compared to the financial crisis, where both the Congress and the Fed were a bit slow on the uptake, that was not the case here. So I think we should look at that. The PPP is a bold experiment, and as I'll come back to, so too is the idea of a Main Street lending facility that's more inchoate. The hard part is, what's the goal? Normally, when we talk about intervention in a recession, we're talking about things like multipliers and who's marginal. This is not a stimulus the way economists normally talk about it. The original goal of PPP was, has already been said, freeze framing, if you will, the economy until the virus improved in March. That was a reasonable outlook, perhaps less so now. And the reason for that aid is really, from an economic perspective, worker firm matches that are very important. We do care about existing businesses. It's not the case, as some economists seem to believe, that we don't care. Some businesses fail, other businesses come, who cares? That's not the way I see it. They're very, very valuable worker firm matches. The one caution I would say to that point, given some of the present remarks, is while very small businesses are the majority of businesses, and they probably are the majority of the political concern about small business, the worker firm matches may actually be more valuable in the larger small businesses. So I wouldn't throw them under a bus of aid, but that may be just one person's view. So I think the Congress was right not to worry too much early on about who's marginal. It just threw a lot of money at an important problem. But we're at a different point now. Now, what do small businesses need? What did they need when CARES happened, and what do they need now, Roger? I think it's equity. Basically, you could go through a lot of economics, but it's pretty simple. They had a huge hit to their collateralizable net worth and their cash flows. They needed equity, not debt. Now, the grant structure of PPP made that possible. It is also possible to take the Main Street lending facility and change the terms. I and others have tried to propose that to them, to make it mimic equity, even though it facially looks like a debt contract. A second thing, and it's already come up in Steve's remarks too, is what was needed was a revenue replacement program. We really shouldn't be so focused on micromanaging payroll. I thought that was a bit of a design mistake. I think the Treasury and the SBA made it worse. The Congress then came back and made it better. But I think we need that kind of flexibility. And the reason to intervene like that, I think in service sector businesses like this is lost demand for a long period of time. It's not like a durable goods seller. If he or she doesn't sell today, sells tomorrow. That's not the case for a restaurant or a service sector business. As Steve notes, many countries pursued another way. That other way makes perfect sense, of basically using a tax authority to deliver a wage subsidy for a variety of reasons, most of which are just boring administrative reasons. We couldn't do that. It wasn't that it's some theoretical difficulty. And I agree with Steve that we definitely need to fix that. In the current environment, I think there are two questions I'll wrap up. One is, did the PPP succeed? It really depends, of course, on what you think its goals were. But if you thought its goals were trying to improve the financial position of small businesses and employment, I think the evidence that we have on survival from Bartic and others, David Otter's work with others on payroll employment, the Brookings paper I have coming out next week with Mike Strain on financial viability and employment all suggest very substantial effects. I don't think it's appropriate in those data to measure cost per job for two reasons. One, the whole point of the PPP wasn't, or at least in theory, wasn't about employment. And second, you'd have to net out UI anyway. So those are odd calculations. In terms of going forward, where I would like to see a lot of attention is the employee retention credit that Steve mentioned. The IRS investments, I think, are also very good. But two others I would put quickly on the table are one, to get the Main Street lending facility right. I say that not just from an academic perspective. There's a bunch of money sitting there. The Congress gave the Fed $454 billion of capital, and the Fed is still sitting on almost all of it. That program is not well designed. It's not designed either for somebody who want to lend or want to borrow, but that's fixable. The second is the short-time compensation program. It's been on the books, 26 states, I believe, maybe I have the number wrong, something like that, use it. That is something that is quickly scalable. So very interesting paper from Steve. I do think we need to pivot in how we think about the problem, but as Senator Cardin said, it's still very much with us and we've got to get on it.
Thank you, Glenn. I'm going to come back to one or two things you said, but let me turn to Tom. And Tom, my question is, if in fact the Congress is unable to agree on another economic relief bill, and we are looking at early next year at best, what's your assessment of what the effects of that interval will be on small business failures, and what's your what do you think the chances are that a small business piece of legislation could be detached from the other issues that are so difficult to resolve between the leadership and separately passed?
Oh, thank you, Roger. And first of all, let me thank Brookings for including me in this discussion. Going back to Senator Cardin's comments, the only critique I would give would be loudly cheering from my observations of what the senator said. Everything that he laid out are things that the U.S. Chamber of Commerce believes in and wants to happen. And quite frankly, from a small business perspective, are optimistic that it will happen. The U.S. Chamber of Commerce represents about 3 million businesses. And what some folks don't know, that includes the partnerships we have with close to 2,000 local and state chambers of commerce. About 96% of our membership have fewer than 100 employees. 75% of our membership have fewer than 10 employees. And in answering your first question, Roger, about what's my prediction of what happens if Congress is not able to come together, I'll just quote from Steve's paper, and that is, it would be catastrophic for small business. I mean, I think Steve laid out a very good baseline from which he makes certain recommendations. And that baseline is terrifying. I mean, what we've seen in our surveys, and we have a partnership with MetLife on surveying small businesses, we actually see it's good news, bad news. I'll pretend to be an economist here. So the good news is that small businesses are very bullish on 2021. Shouldn't surprise any of us who have been following small businesses. They're generally very optimistic. The difference right now is that optimism is pushed out. And what we've seen over the last 6 months is that optimism has been pushed further and further out. At first, it was 4 to 6 weeks, then 4 to 6 months. Now that bullishness is well into 2021. Now, the bad news is when we ask small businesses, how are you doing right now? They're at 14 percentage points lower than they were at this time last year. And Steve and others have mentioned already that, and I'm sure Luce will get into it in a moment.
14 percentage points of what?
Oh, so what we do is we ask small businesses ranging from a percentage score of 0 to 100%. How satisfied are you with your current cash flow situation? 55% say that they are comfortable with their current cash flow situation, which actually doesn't seem like a bad number. However, when you compare it to this time last year, that's 14 percentage points lower than it was. So those are the percentages that I'm talking about. But when we look at that baseline that Steve lays out in the paper, it is even more catastrophic for Black-owned businesses and minority-owned small businesses. We see 66% of minority-owned businesses saying we're done for good. And that is just, I mean, when you're thinking of 6 out of every 10 businesses that you walk past in an urban setting being closed for good, I think catastrophic is the appropriate term. Without going too far into the catastrophic kind of nature in this, I'd like to end by answering your second question, and also end with bringing in some of the optimism that I get from representing small business. I mean, I'm lucky to be able to talk with small businesses every day. And even though this is a terrible, terrible time for them, they still have that optimism. And when they read or hear or talk with their senators and their congressmen, they are hugely frustrated that the pieces in the House and Speaker Pelosi's legislation and in what was called the skinny package in the Senate that was promoted by Chairman Marco Rubio, they're identical. And this gets at your point about why can't we detach those pieces of agreement and simply bring them together? And I think that more and more of the voting public are cluing into that, and that pressure will build for them to pass a stimulus on those areas of agreement before the election. So I'm optimistic. I would have pegged the chances of that happening at about 40% yesterday, but then the president expressed his frustration with what I just outlined. So I think we're now up to close to a 50% likelihood of that happening.
I hope it goes north from there.
Me too. Thank you.
Okay, let me turn to Luce. Luce, you heard Glenn Hubbard say that he thought the right form of assistance going forward for small business, especially micro business, was equity. I wonder if you would comment on that, and also more broadly, whether you think there's any role, or what that role might be, if there is one, for private capital in this whole solution going forward, thinking of various types of private-public partnerships.
Thank you all very much for having me today as part of this great event. You know, I think on your first question, Roger, you know, at some point as the economy recovers, there should be a transition from, you know, and I assume equity and grants sort of in one category, for particularly for the smallest, most vulnerable businesses. So, you know, for many businesses right now at this point, they are still too vulnerable and cannot take on debt. So I do agree that there is a portion, and let's remember, right, not all businesses are created equal. Therefore, not all businesses are having the same challenges. Some are having significant challenges. Many of them have closed. And there are others that are still opened and have pivoted and are doing okay. So I think this is not a one model, one size fits all, but I do in principle agree that equity and grants is what many small businesses need today. You know, it's been talked about it. There's a vast majority, right, of minority-owned small businesses that did not get access to PPP, which in our view was more like a grant, not a loan, but it was pegged to payroll, and it has been explained here, you know, if you're closed, then you're not paying employees. We support grants and equity to help level the playing field and help those businesses pivot and reopen. Some businesses, however, and we're seeing it out of our own, you know, organization, can handle loans at very, very subsidized rates. But a majority of businesses today, I venture to say not many, can handle loans at market rates. So there is sort of a ladder of where they are right now, grants and equity, and potentially as they start to recover and things start to look better, then I think debt is probably, you know, there's more access to it and more availability. I want to go to the question or the point that you asked for, you know, partnerships. I think we need to start by talking about what was the lay of the land in terms of capital before COVID, right? We all know that there was an $87 billion reported gap in capital for loans under $100,000. We also know that banks not generally are supporting, mainstream banks do not generally lend to these underserved businesses for a variety of reasons. The loan sizes are too small. The businesses are in industries that are perceived to be high risk, the profitability of the loans. So there are many reasons why banks are not directly lending. There were a number, and still are a number, of alternative lenders, online, fintechs, merchant cash advances, some that are great actors, some that are terrible, terrible actors that were serving the capital need of this community. What we're seeing is that, you know, after COVID, banks are going to retrench. They're going to shut down further on their credit boxes. Some of these fintechs and online lenders are going to also retrench due to their own losses, capital structures. So the capital gap is going to be significantly larger than it was pre-COVID. So to meet this capital need, we believe that innovative public and private partnerships will really be critical to deploying capital to small businesses to help them rebuild and revive the mainstream economy. As an example, there's been a number of funds, one in New York, one in Chicago. We have created in California, Opportunity Fund has partnered with Silicon Valley philanthropists, CDFIs, community foundations, attorneys, banks, and the Calvert Foundation to launch the California Rebuilding Fund to raise $1 billion for California small businesses to provide loans between $10,000 and $100,000. This is a public-private partnership aggregating funds from private, philanthropic, and public sector sources, and also leveraging an anchor commitment from iBank, which is the state's infrastructure bank, to address the capital and advisory needs of these businesses as they reopen and recover from this crisis. You know, this fund is great because it's designed to help CDFIs access the liquidity that we need to provide risk mitigation and support that is going to be required to.
Has the full $1 billion been raised?
No, it has not been raised. We are in the process. We are expecting to launch a first tranche with about 50 million. But, you know, I think that when we talk about who needs to participate, this is not a one organization or one-stop shop. This is a combination of public and private sector, and particularly the government participation in solving the problem, whether it is providing loan loss guarantees or first loss commitments for lenders to feel good about opening their credit boxes, about lending into the communities and providing the resources that CDFIs are going to need, because we're the ones that are going to be left to support these underserved minority, immigrant, people of color owned businesses. And we need the liquidity and special purpose vehicles so that we can leverage our balance sheet and have more capital to lend. I'm very encouraged. I see for the first time an enormous amount of conversation and collaboration between members of the ecosystem that are frankly more robust than I've seen in my entire financial services career. So I think we're on the right path.
So let me take advantage of the really interesting point you made about this proposed California fund to ask this, and I would invite any other panelists to jump in and answer this if they would like. But I'll ask you, Luz. If you were the governor of California and you thought that the Congress would not be able to agree an additional relief bill before next year, what would you try to do yourself at the state level? And what do you think the state of California, which has a lot of pressures on it, God knows right this minute, is capable of doing by itself? Because one of the obvious questions here is, what additional steps can states and local governments take in the absence of further federal action?
Yeah, I mean, I believe that, the state of California, particularly with what iBank has done, has been incredibly generous and frankly, within their limitations, right? So iBank has launched this, loan guarantee program that is going to enable us to raise $50 million worth of capital to put in a special purpose vehicle. And it's, up to 95% guaranteed by the iBank. They've also deployed another $25 million as a first loss reserve that's going to help us leverage another $150+ million worth of capital. As you mentioned, all states are in a very difficult time right now. I think that, one state can't solve the problem for the situation that we're in. I think that, if Congress did their job, if you think about CDFIs didn't come into the situation strong either. In many cases, we're like our small businesses, right? But we're significantly important because we need to be able, we understand the communities, we lend into the communities, just like other minority depository institutions. And so we need to be able to have our capital and our leverage to be able to help businesses get out of this, right? I think that Congress, when you look at what does a state do and what California has done has been terrific under the leadership of the iBank. But also, I think there needs to be other federal programs. We're talking and been talking about for a while, approving $2 billion in emergency funds to support the CDFI fund. The CDFI fund also talking about setting aside $1 billion to support, CDFIs that need to provide loans to small businesses. And then something that I think was very elegant that was done back with the Great Recession was the State Small Business Credit Initiative, which at the time helped to fund some of the best loan loss reserve programs that states throughout the country still are utilizing to help lenders get more comfortable with providing credit to underserved communities. If you think about the leverage, every dollar that we get in federal funds, we can leverage $8 in private sector capital to small businesses. These are incredible numbers that make total sense from a business case perspective, not to mention the business case from the impact that it would have in small businesses to help preserve our neighborhoods, which we all have talked about are decimating as we speak.
Okay. I know Tom would like to jump in on this question of what the states and localities can do in the interim. Go ahead, Tom.
Thank you, Roger. I actually just want to emphasize that even though Luce and you are talking about some of the innovation happening at a state and local level, there is actually a federal role to play here. And that is the officials at SBA, the officials that oversee CDFIs at Treasury, the officials that oversee the Minority Business Development Agency at Department of Commerce. They can recognize what's going on in California. They can recognize what's going on at Maricopa County, Arizona, and then simply amplify the positive impact of these things. I'm a huge fan of competition.
Yep.
And there's nothing wrong with another governor looking at what's happening in California and trying to create their own program, their own fund, their own investments. And one way to do that is to have the federal government acting as resource partners, simply highlight some of this innovation going on in the states.
I could not agree with you more. And, that's why we are constantly advocating for the Small Business Credit Initiative funding from the federal government, for the CDFI fund, because those are leverage points that provide capital to communities that need it the most.
All right, I'd like to turn this back to Steve and to Glenn and ask this question, and maybe each of them could briefly comment on it because we're getting down to the last few minutes. Steve, your paper points out that a number of other countries took the approach of revenue replacement. In other words, the federal assistance was designed to replace lost revenue rather than address payroll. My question is, in retrospect, do you think that was a more effective approach? And secondly, would it have been possible, just given the magnitudes, for the United States to have taken that approach itself?
Yeah, Roger, that's a great point. So with Stan Voiger at the American Enterprise Institute, I released a proposal in March to do exactly that, which was a program like the PPP which replaced revenue. And I know Glenn at the same time had a proposal with Michael Strain at the American Enterprise Institute suggesting something very similar. So I feel like coming to independently the same solution is probably a good sign. The businesses have, it's that they don't have enough money coming in. It's not that their costs are too high, right? And the other problem is ultimately some businesses have different cost structures, fixed costs, variable costs, high cost, high margin, low margin. There's all sorts of businesses. Providing support for costs, it is a sort of imperfect fit. So what I tried to do with the proposal is to massively improve the flexibility of the cost coverage so that it's closer to mimicking revenue replacement, right? So allowing significant coverage for non-payroll costs tries to get closer to a revenue replacement scheme. I think a revenue replacement scheme would have been more expensive, but the biggest barrier, I think, was political. It needed to be tied to payroll in order to get a bunch of people to vote for it and support for it. And so I'm not sure I can, solve that problem with any number of policy proposals.
Glenn, would you weigh in?
Yeah, I would agree with what Steve said. I mean, Mike Strain and I estimated the cost of a revenue replacement program for 500 and fewer employees over a slightly longer period than PPP was originally designed to be about $1 trillion. Now, that may sound off the charts high, but as PPP costs have grown and it's a more restricted program, that sounds about right to me. And
well, PPP was about $700 billion, even though they didn't spend quite all of it.
Correct. So that's why I say $1 trillion didn't seem off the mark. So I agree with Steve. The issue was politics, not economics. There was a day where numbers like 700 billion or $1 trillion took a program off the table. We're not in that day, for better or for worse. So I think this was politics, and it's a shame. And I think maybe people didn't really understand the extent of the payroll problem versus just general revenue replacement.
One follow-up, and either I'll ask you, Glenn, but Steve may want to weigh in as well. Do you think that the PPP, or for that matter, any variant of the PPP, would have been more effective if the cutoff on the size of business, 500 employees, which was the PPP cutoff, had been a bit lower? I wonder myself whether if it had been half of that or 2/3 of that, whether the assistance would have been more targeted and therefore more effective, but I'm not sure.
I think the honest answer is we don't really know. Mike and I did find smaller employment effects for the larger end of the small business firms, but still improvements in their financial viability. And to the extent that you think the worker firm matches are valuable there, it still could be an issue. There are two issues of targeting I just want to comment on quickly. One is, be careful, because in the fog of war, I don't know that you want to draw the lines so finely. And then, there are just general issues about revenue declines that I know are fascinating members of Congress in the current bill. I'm not so sure why, if I'm a small business who's managed to have my affairs do better than your small business, why I should be punished relative to you. I struggle a little bit with that. I see what they're trying to do, but it's just wrong-headed from an economic perspective. It may be great politics.
I think there's anybody else may want to weigh in on this. I think there's a tension, or at least a theoretical tension, between payroll retention and small business survival in the following sense. As has been said, this small business crisis has fallen disproportionately on minority-owned businesses, and I think, and anybody want to correct me on this if I'm wrong, broadly businesses in low-income communities. Some of those businesses are pretty indispensable to those communities. They supply food, they supply certain other necessities. So there's that tension between, gee, here's a firm over here with 500 employees, and I'd like to enable them to retain most of their employees, but we know they're going to survive. They're going to survive just fine. Versus a small minority-owned business or immigrant-owned business in a low-income area, without which the community would be devastated. So I myself think that if this had been a bit more targeted to business survival, just just moderately speaking, because of course employment is terribly important, it might have been more effective. So Steve, if you want to comment on that before we wrap up.
Yeah, so I agree. I mean, the 500 employee limit is arbitrary. It's just what the SBA or whoever defines as small business. So draw the line wherever, right? It's hard for me to know. I agree with Glenn. I'm sympathetic to targeting on revenue losses though. And I think, the PPP went to 72% of all businesses, which is extraordinary. That's 2 months of payroll handed out to 72% of all businesses. So I think we're going to see in the aftermath that there will be a number of businesses who will have profited, in the crisis compared to before. And the other problem is all the money doesn't go out at once. So because the money was limited and because it was so widespread, the money was rationed, right? So not everyone got it straight away. And I think a lot of businesses wouldn't have been able to wait several months to get the money from the PPP. I agree with you. I think there hasn't been enough discussion of survival. I think really the pitch of the proposal I present today is business survival, right? Ultimately, to me, we should care about employment today, but even more, we should care about employment over the next 5 years, which is going to depend significantly on firm survival. And a striking point is there was massive loss of firms on net in the global in the Great Recession, and it took over a decade to get back to the number of firms we had just prior to the crisis in 2008. So it's so much quicker to destroy businesses than it is to create them. And so, I mean, again, an economist, it's pretty easy for us to see. We got to try and lean against this wave of catastrophe that's coming.
Well, I'm sorry to say that our time has elapsed. I want to thank our 4 panelists. I thought they were outstanding, and I appreciate very much their participating, including at 4 a.m. And I want to thank Wendy and Kristen and Melanie and the Hamilton Project staff for, again, putting on really quite a terrific event. And hats off to you. And again, thanks to everybody for participating. I hope everyone who tuned into this really enjoyed it. And on to the next one. Thank you very much.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.